Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, Bloomberg's UK Wealth Editor-at-Large.
And I'm John Stepek, Senior Reporter and author of the Money Distilled newsletter.
Oh, hi, John. Now, listen, we've been talking about the election and the election and the election and the election, and we're not going to talk about the election here. We have a pod coming out tomorrow with two brilliant guests in which we're going to fully dissect what the US election means for global markets and for UK markets. So that means, hooray, John, that you and I don't have to do it here.
Yes.
Good news, right?
Definitely.
Oh, you want to talk about the election, and now you can't.
Oh, I don't. It'll descend. It will descend into a rant, and that's not good.
What? Between you and me? No, it won't. Listen, I tell you what, I'll give you one sentence. What does it mean? What does it mean for the UK stock market?
We've got serious competition. Actually, that's what it means. We've got serious competition, and we really need to sort ourselves out, or else we're going to be left in the wake of America for another 15 years.
Yeah, well, let's hope someone from the government is listening. We need to sort ourselves out. But what we're going to talk about today is the Bank of England decision, interest rates. Does that help sort us out? Today, the Bank of England cut interest rates by 25 basis points. We're now down at 4.75%, which was exactly what everyone expected, right?
That's exactly what everyone expected. And I think about the best thing you can say for this Bank of England decision is that they managed to get through the whole decision and the press conference without doing anything to the gilts market. Because, I mean, look, it's from all this stuff. So the budget came out, it was rubbish on growth, and it was a little bit inflationary. And so what happened in the gilts market is the gilts went up like a lot relative to what they normally do in any budget apart from the 2022 one. But the difference between that and the 2022 one is it was a purely rational repricing according to what Rachel Reeves had decided in the budget. And because it's like a little bit inflationary and it's rubbish for growth, that means that we're likely to have interest rates higher for a bit longer because the Bank of England will need to keep rates a bit higher to tackle the extra bit of inflation, in theory anyway. And that was all just confirmed there.
Also likely to be a little bit of extra inflation coming from the US. I mean, if tariffs are introduced, if we've got extra spending coming into an economy that's already quite hot, we can expect a little bit of inflation added as a result of that as well. So we can't really tell, and we haven't really been given any guidance on where it is that the Bank of England expect rates to end up in this cycle.
No, and the other thing is, I mean, the bank itself was basically saying, look, we just need to wait and see. Because, for example, they talked about the employer national insurance contributions, and they think that's going to be a little bit inflationary because some of it will pass through to prices, and it will also restrict the labour market slightly, because it's driving up the cost of labour. But at the same time, they're kind of like, we don't really know until we've seen exactly how companies push it on, because it might squeeze some small businesses out of business, basically. Alternatively, maybe the fact that everyone now knows what's in the budget will at least make the economy a little bit more, a little bit better, because nobody's waiting to find out what's going to happen because it's happened.
So we don't really know where we're going to end up, John, but we kind of expect something like 4%, 3.75% by the end of this year, beginning of next year. Reasonable.
Not by the end of this year, but
next year.
Next year. That would be quite good. And I think honestly, I just think the main thing for normal people to take away from all of this isn't so much, where the bank ends up exactly. And at the end of the day, this is only a quarter point difference from what it was before. It's more about we aren't going back to the post-2008 days. And also we aren't actually going back to the pre-2008 days either, because back then we were in a disinflationary trend, and now we're in a inflation volatility trend, if you want to call it that, and that inflation's going to be somewhat higher and it will be jaggier as well. It'll be more prone to spikes. So, it's not going to necessarily be that pleasant, actually, in lots of ways.
Yeah, I'm not going to get anything optimistic out of you today, so I can
it's
feel
bad,
it.
I
can feel it. But
it's not good, is it?
But listen, one thing that listeners do have to take on board is that savings rates are falling. So if you haven't locked in good rates already, it might not be the worst time in the world to do it. We saw NS&I cut rates on quite a lot of its saving products yesterday. Premium bonds, the prize fund rate went down. I have premium bonds. I always hate it when I see that. Now from 4.4% to 4.15%.
I mean, that's a little bit previous of NS&I low, because, I mean, like 5-year swap rates have gone up like a lot in the last 6 weeks.
Yeah.
And so, I mean,
Yeah.
I would expect to see, ISA rates and things like that to actually possibly even nudge a bit higher, or, something coming out of that, because mortgage rates are probably going to nudge a bit higher.
Yeah, I don't think you're going to see that. That's not how banking works.
Well, yes.
The other one to point out is the NS&I Direct Saver account, which I know a lot of our listeners will be saving their cash in. That's down from 4% to 3.75%. So below 4%. That's a bit disappointing. The other disappointing thing I wanted to talk about briefly today is something I know we do go on about quite a lot, but the increase in the cost of tuition at universities in the UK. We've been told that is now going to start going up by inflation, which you might think is not unreasonable. All costs should go up by inflation. Universities have been suffering no end as a result of not seeing a rise in the fees that they are paid. And we hear regular complaints from students about how they are not getting value for money, or what they think would be value for money in terms of FaceTime with lecturers and tutors, etc. So the price of university is going to go up. There's been a great big fuss about it. But I think, John, you and I both believe that that's a complete red herring next to the appallingness of the student loan system in general, which of course we don't think is a loan system. It's more of a tax system. So whatever the price of the degree is, the repayments for most students effectively remain the same, right?
Yeah. And it's just that, as you say, the real issue is this 9 percentage point tax on, students. And it really is wild when you look at the marginal rates. I posted about this on LinkedIn the other day, and I think there must be something with marginal tax rates that just really kind of like stimulates people to get, annoyed or excited or something, because I very rarely get that level of engagement. But, lots of people, and I think it really kind of strikes home, because, so, we've got a marginal rate between £100,000 and £125,000, and we do talk about this quite a lot. But you're paying 60% income tax at that level because your personal allowance is being withdrawn. You're paying 2% NI on top, so that's 62%. And then you get your 9 percentage points of your graduate loan getting paid back. So that's taking you up to 71%. So you're keeping less than 30p in the pound of every extra pound you earn.
You're not including pension auto-enrollment, which I think is really important to add on as well, because while it's not technically a tax and it's also technically voluntary, you can opt out. It really is a tax, because I think we all slightly suspect that one day it's going to be replacing our state pension. So if you're not paying into that, you're going to be in a lot of trouble later. So you've got to add that on as well, right? So you're heading up to 75%.
Well, yes, so it's 71, call it 76 with the 5 percentage
76,
points.
Yeah.
And then if you did a postgrad degree, that's 6 percentage points on top of that, because they get charged at the same time. And also your postgrad degree kicks in at a lower income threshold than your graduate degree. So once you're earning more than 21,000, 6 percentage points of your salary comes off. So yeah, you could be up to 82% if you were a postgrad, earning over £100,000. And presumably one of the reasons you became a postgrad is because you wanted to earn over £100,000. So it's, and I mean, okay, at that level, if you're getting paid that salary for a prolonged period of time, then yes, you will probably pay your student loan back earlier than, some other people. You might even pay it off before the 40 years is up. But it's still an astonishing barrier, I think, to people who to striving, basically. Yeah, and I really do think that.
Yeah, and to productivity. There's extraordinary high rate of marginal tax that people who have graduated from UK universities have to pay pretty much throughout their working life. There's got to be a barrier to people wanting to take on more work.
Yeah.
It's got to be a productivity issue. And of course, it's going to play into the fertility issues that we talked about the other day.
Well, yeah, exactly. I mean, like if it's costing you so much to set up the kind of home that you want to have kids in, and then and also the delayed start of all that because of extended education, then yeah, we're just going to keep making things worse. I do think something on the university front needs to change, whether it boils down to more people taking advantage of alternatives. Like I think it's encouraging that apprenticeships are now seen as an alternative route. I also think that trade I think if middle class kids understood better because they tend to follow pathways, if there was a more obvious pathway to becoming a plumber or a brickie or an electrician, then a lot of them would do that instead. And I think the main kind of barrier to that, if you like, is weirdly the inverted one, the academic one. It's like they don't understand how you get to be a plumber the same way as maybe a plumber's kids don't fully get how you get to be a lawyer. And I think that if we could maybe communicate those things a bit more broadly, we'd have much more diversity within all the different trades, but we would also, have fewer rubbish degrees. Because what was it? I saw someone put out a stat this morning that there's a small group of universities where like a third of the students that have graduated have not paid anything to their degrees. Why are we subsidising that?
Yeah, why is it happening at all? Listen, I'll tell you what, I did something very interesting this week. I learned about the cooperage trade, making barrels, for whiskey and wine, etc., etc. And I can tell you that is an extraordinary trade, a niche trade, highly skilled trade, one in which you can get an apprenticeship. And if you're really good at it, you're going to find yourself paying that 60% marginal rate. Money's good. Absolutely fascinating. And, these many routes to earning well that the middle classes and, those of us who think there is only one route to success and it's through university are really missing.
Yeah, I think that is something that we could definitely do with addressing. And, I think people will find these routes off their own bat once they realise what low value they're potentially getting from uni. But, you could accelerate that process just by making it a bit easier to find.
John, that was all pretty depressing apart from the cooperage bit. Have you got anything else you'd like to add that is positive, be it about the election or the Bank of England or even the budget?
I would love to, but I know what, it gave me a really good topic for Money Distilled today, so go out and read that.
Okay, don't listen to him, go read him. Money Distilled is an excellent newsletter and I'm sure you've all signed up to it, but if you have not, now is your chance because John's not going to tell you his positive news. You have to go and read it. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter @MerrynSW and John_Stepek. This episode was produced by Sam Asadi, production supported by Moses Andam. Questions and comments on this show and all our shows always welcome. Our show email is merrynmoney@bloomberg.com.